Hey there, Tim from Alpha Wolf Trading, wanting to thank you for stopping by to watch this interview and also make it clear to you that this is not a paid-for promotion. I collect no compensation for the interviews I do here. These companies have been identified as opportunities for investment that could provide an above average return on our investment. This is our opportunity to get to know management, to understand the vision for the company, the strategy they plan to implement, and execute to achieve that vision for the company. So if you learn anything here today and you enjoyed the interview, please do us a favor and subscribe to the Alpha Wolf Trading YouTube channel. Hey everybody, Tim from Alpha Wolf Trading coming at you with another follow-up from one of my favorite. This guy's really intense. He always makes me nervous every time I get on with him, man.
Wow.
Chuck Ferry from DUOT Technologies, ticker symbol DUOT. And Chuck, you just reported a fantastic quarter. It's not surprising that the market isn't paying attention or doesn't care at this particular point in time, but that's okay. Eventually they will start to get it. Chuck Ferry, thanks for taking the time to come in and give us an update. But how you feeling, Chuck?
Yeah, good. We did all our prep to close out the quarter, along with our I call it my speech, my quarterly earnings call, and everything went pretty well. So I think the team was kind of that prepares all that stuff. Was pretty satisfied and kind of having an easier day today, so to speak. Yeah.
All right, so let's talk about a couple of things. Let's talk first of all. Let's talk about the just to clear the air on the recent cap raise, right? Maybe that's what's got the street a little sour. I don't know, but I thought it was I thought the deal was clean, and I thought that the reason for the cap raise is a legitimate one. I mean, is it a risk? It's a little bit of a risk, but I think it's a well calculated risk.
Yeah, well, I mean, we decided in the past this company has raised money like many small companies in our category, to survive, so to speak, and investors like that. In this case, this was not a survival raise. This is a raise basically to invest in our future. And so the proceeds that we raised, and I'll talk about that here in a minute, and the structure of it, really was designed to help us begin to do some of the procurement for the long lead items that we're going to use in our subscription portals that are planned for this coming year. And we can talk about that, as well as kind of making sure that the work that we do have in contract now continues on its pace. So we have several projects that are in progress right now. All of them are being delivered on time and on plan, which again is a little bit different than perhaps it was 2 years ago. So that's good news for us. The raise itself, it actually closed over 2 different quarters. So we reported, I think, around a 3.5 number. In actuality, we raised $4.2 million. It was done at $3 a share, but it was a very clean deal. It was almost exclusively all common stock, with a small portion of it in a preferred category, but all of it was pretty much done in common. No warrants, no crazy business, but pretty clean. So our bankers, it was done through Northland. We kind of gave them a tall order because they told us, hey, that the market is very, very difficult right now. But we told them, hey, look, we wanted a clean deal, and that's the way it's going to be. And they were successful. And we are, again, beneficiaries of some of our more long-term shareholders that invested again with us in this round. You know, and they're telling us the same thing that Tim, you kind of tell us as well. It's like, yes, we're worried about the stock price, but don't worry about the stock price right now. Just build value in the company. That's where we're at right now.
Right. And look, that's where it should be, right? I mean, the market is a little volatile overall.
Yep.
A lot of uncertainty out there. Some of the stuff is starting to clear up a little bit now that we have the elections behind us, right? But there's still a lot of uncertainty about the inflation environment, you know, supply chain issues, all of that stuff. But I think we're even starting to see some clarity on the supply chain issue stuff, at least from some of the companies that I speak with. It looks like it's kind of loosening up. And the inflation part, look, I don't know how many more times the Fed wants to take a 3/4 whack at it, but I think he's gotten a little over aggressive, in my opinion, already. So that stuff takes a long time to work through the system, but we already started to see the numbers come down, the inflation numbers come down. So I think things are going to look better than everybody is assuming they were going to just 3 months ago.
Well, we're you know, given all those headwinds, and we are impacted by the supply chain. We've talked about this before. In particular, for us, cameras and servers, which both require chips, continue to be, you know, extended in terms of lead times for us. You know, we've kind of, I guess, come to accept it, and now we're just trying to, you know, work it into our plans. And that was part of the reason why we did this raise, because if I don't buy the stuff now, I won't have it for next year. So that was part of the raise. Secondarily, yeah, inflation certainly has impacted us like everyone. Fortunately for us, our customers, which, you know, primarily are our Class 1 customers and our one large passenger rail customer, have been understanding in the fact that we need to come back to them with some modest requests for price increases, and they've been supportive of that. The industry that we serve, the railroad industry, is actually doing quite well. So, you know, if you look at the earnings reports for some of the large Class 1 railroads, and even the, you know, passenger railroad like Amtrak, I mean, financially, they're doing fairly well right now, despite all the difficult, you know, financial times right now.
Let's talk about the main reason, but besides that, is to build these portals that you've been selling to customers, but now you're going to have, if I'm right, a separate division still with underneath the parent company, but of portals that are company owned.
Yeah, that's right. So basically, you know, the premise is this, and it's all driven by you know, data and analysis that's now been confirmed by a number of rail subject matter experts that we've been able to bring into the company here really over the last couple of months. And that is that, so I think the numbers we put out in our call yesterday, we've seen, you know, approximately 2 million, we've imaged 2 million rail cars across our fleet of rail inspection portals. 11 of them in the last 90 days or so in the last quarter. Again, about 10% or so of those cars are owned by a Class 1. So 90% of those cars are owned by, you know, a car owner, a car lessor, you know, a major shipper, and those companies ultimately bear the responsibility for safety. As well as, more importantly, the cost of the maintenance of that car. So the Class 1s, they take possession of those cars. They are responsible to operate them safely. The Class 1s do maintenance on those cars, but ultimately the cost of all that for the ones that they don't own, it's on those folks. So we've been in discussions now with somewhere in the neighborhood of 15 to 20 customers. They go across the gamut of car owners, car lessors, short line operators, as well as shippers of large things like, you know, coal operators, potash operators, you know, plastics and chemicals operators. So all of them are a little bit different, but when we show them the capabilities of our system and the data that it can produce, they really sit up in their chairs and become very, very interested. When we now offer that to them in a subscription format where the price is significantly lower, the hurdle is now, it's now in an area where it's like, how can I say no to it? So I think in the next 60 to 90 days, we'll be able to report that we've signed on, a number of subscription customers. We've already signed up one lucrative customer already. We're making good progress and started discussions about potentially buying some of our portals back from our Class 1 customers. And then lastly, we have identified 3 to 4 areas that we think we could go into in terms of obtaining right away from an anchor tenant, and then building our first 4 to 5 portals for next year. So we're full steam ahead with this.
So the portals, and we touched on this before we jumped on the call, but you brought in an industry expert for that is helping you determine the pinpoint accuracy point of where you want to put these portals, right?
That's right. So in the last 2.5 months, we've brought on some pretty key talent that I'd say was going to help us from a railroad industry expertise, but also a railroad commercial expertise, if you will. So Matthew Keatman, he's our senior vice president for sales and marketing, or basically our lead sled dog, if you will, for all things commercial and sales. Matthew previously comes to us. He spent quite a bit of time with Wabtec, which is a pretty big player in the rail industry. And he had previously been the senior executive that managed all of Wabtec's portfolio with Canadian Pacific. Prior to that, he's got a real wealth of background, all inside rail, not only with Class 1 railroads, but also with a lot of the car owners, as well as a lot of the shippers. So he's our lead for sales, and we're adding more talent to him and his team right now. So just in the last 6 to 8 weeks, he's already generated, some very, very mature leads, based on his, knowledge and contacts in the industry around this subscription. The second guy is David McKee. David McKee retired, but had agreed to come on as a I'll call it a strategic advisor to me. Over 40 years in the rail industry. A lot of it was spent inside CSX, where he basically designed the operating plan that moves, all of CSX's trains as efficiently as possible between point of origin and point of destination. He's also done similar work prior to his retirement. He ran a short line railroad, and then he also has helped a number of our car owner companies kind of write their operating plans as well. So he is an absolute expert at laying the map down and getting down into the nitty gritty about, okay, here's exactly where we have the best traffic, the best commercial opportunity, and we'll have the most strategic impact to the rail network. And so we've already kind of laid those down, and we're in the process of now talking to those owners of the right of ways, to progress this.
So I think so. Look, initially, well, let's talk about the quarter. You just reported a great quarter. How did you hit your numbers?
We did, and so the analysts that coverage that we get was thinking we'd hit somewhere between 3.5 to 4. We did hit just north of $4 million. If you compare it to last year, it's about 130% year-over-year growth, and we've reiterated our guidance for this year. That is, we'll finish the year $16.5 to $18 million, which, if I read my notes here, is somewhere between like a 99 to over 100% revenue growth year over year. So that's a good quarter. I think more importantly for us, for me as the CEO, as I look back over the last 4 quarters now, we've successfully hit the financial targets that we set for ourselves now successfully over a number of quarters. And then if you look at our trailing 12-month numbers, if you take the last 12 months, we've made, I think, north of about almost $13 million. And so that's higher than any 4 quarters that's ever been put together. So I think that's good news for us.
In its entire history.
In its entire history, yeah.
Yeah.
Again, we're still a lot smaller than I'd like to be. I'm used to having a much larger company, but double digit growth is good.
Yeah. How long you been on the job now, Chuck?
Just a little over 2 years now.
A little over 2 years, right?
Yeah.
So a little over 2 years. Company never even came close to. I don't even think breaking even.
No, so we're now, given those numbers, we're still not going to break even, but there's reasons for that, right? So I mean, we've done a good job of controlling costs, but to your point, like we were talking before, supply chain and inflation is one reason why the costs of that revenue has gone up a bit. But quite frankly, over the last 2 years, the cost of labor for us has gone up. And that's so people don't like costs, but it comes with people that are a lot more talented, here at the business. So we've been able to really upgrade, the staff here across all of the technical disciplines in particular. And we've done that by providing them, a better benefits package. In some cases, for some of the management team, a little bit of equity. And then also, better salary. And now we've introduced performance bonuses because we're definitely a performance-based, organization. So that team is the ones that is producing these better numbers, and I think they're worth it.
Yeah, well, I got to tell you, I'm a huge fan of them owning equity in the company, right? I mean that kind of puts everybody.
We want to align the interests of folks here, that are feeding families and putting kids to school and stuff like that, and make sure that all of our interests are aligned, and really make this a team effort. So yeah, there's some companies where the CEO and maybe 1 or 2 others get all the goodness, trying to make sure that this is a company that really rewards folks. And we have a lot of different kind of tools now that we've introduced to do that. The one that's really my favorite really is the benefits. So our benefits package, this was real important to us in some of my previous companies, but having a good set of benefits, especially when we have young folks that are raising young families, is very important as a retention tool for us right now.
No, I love that. I love it. So, look, initially you're going to take, so maybe you're looking at some outlay of expense, right? Because you got to build the portals. You got to put the equipment in there.
Yep.
But at some point, those portals get paid off, right? Those initial costs get paid off. You're going to have maybe a lease for the little portion of land that you're taking up, right?
Yep.
But that shouldn't be anything significant, right?
Yeah, the hurdle compared to my energy company where we own and operated large gas powered turbines and switchgear. I had about $1 billion worth of stuff on a balance sheet. The payback period for these rail inspection portals is pretty good. It probably is no more than maybe 12 to maybe 18 months. But then the upside is you're able to produce enough revenue off these where, I mean, there's a lot of different ways. Look, you could definitely do this in a debt structure if you wanted to. I'm not saying we're going to do that, but it'll throw off enough cash that it'll pay for itself in very short order. So, these portals typically will operate at least 5 years. We have some now that have gone even more than that. So you're paying them off, let's say, in the first year. And by the analyst estimate, if I've got at least 5 portals in a subscription mode with at least, let's say, 10 customers per, we start generating about $5 million of cash per quarter. And so this coming 2023, we're still going to probably have some net loss, but once we get to that fourth quarter and forward, we're going to get to a break even and in a much better where we're self-generating our own cash and our own proper net gross net margins, net profit. So, and then all that'll be recurring revenue. So it's coming.
Recurring revenue at, I would say, high margins, right? At some point, I mean, the margins are going to increase. Initially, they'll be lower, but at some point they're going to increase. And every additional, I would almost call them a tenant, right?
That's correct.
Rent to.
That's right.
Is just adds to the pot, right? How many tenants do you have to have to make a portal?
Yeah. So what we build our business case on is basically having at least 5 tenants. The first tenant is really the anchor tenant, and that's the customer that owns the right of way of that particular spot, right? So they become the anchor tenant. They get the benefit of all of the data because they're the ones who are operating, at that location. We then add at least 4 additional tenants, if you will, or subscribers. The hurdle rate is, I think we've estimated, let's say, if we're making at least $400K a year from each of those tenants, this thing it's probably about 4 or 5 times more profitable in a recurring revenue format than it would have been if we had sold it in a CapEx format.
Right.
The beauty of this is like, let's say we do have a hotel. Okay. Well, hotels are limited by the number of rooms that you have.
Right.
Okay. So once you fill all the rooms, that's how much money you make, and that's your capacity.
That's it.
Build more hotels. This is kind of a cool thing where in my last business, you can only produce so many megawatts with X amount of machines. So if you had them all out, you can make this much money, and otherwise you got to buy more machines. This one here is a little bit different because there are several hundred car owners that are actually pushing cars through these portals. So we're doing a business case of, let's say, 5 tenants, right? The reality is there's several hundred more that would probably like to have the data that we could add in there if we could do that. So it's a business case where we ought to be able to owner operate these things, and actually with fewer portals, we can have more customers, and the customers that come to us will pay less than they currently pay right now. And the data is very, very compelling, and it's getting better all the time.
Right. That's where it gets really, really interesting, right? I mean, if you wind up getting 30 or 40 tenants, and they may be on different subscription plans for different parts of what they're looking for specifically, right?
That's right.
But that's great. You've got pricing negotiation, right? Or you've got some elasticity there, right?
Yeah, and again, it's so financially, it makes a lot of sense. All the analysis and all the discussions that we're having, we know people want it. We know the price is where it kind of needs to be to attract folks so in other words, instead of having to go make a huge CapEx investment, which typically, those are business cases and they compete with other business cases. In this case, this is really an OpEx expense for some of these large companies. That's very competitive with some of the other type of OpEx expenses that they have. But the data itself can really, really help straight on with safety, but also help, these companies do a better, be more efficient about managing their fleets. In the case of where class 1 is, potentially where they have customers that are on their track that are beneficiaries of this data. These car owners are now putting better maintained rail cars onto the class 1 network. So it really is beneficial to the class 1 as well as the car owners to kind of have this data out there, because really the class 1s, they're in the business of running their networks as efficiently and smoothly and safely as possible. And it all kind of lines up. So we intend to prove the concept, and in the next quarter, show meaningful, customers have signed up, as well as some other initiatives to show investors that this is real and this is coming and we can make it happen.
So that's, I guess, if there was something that my dog wants to be part of this meeting really bad.
Hey, it's the benefit of being at home. You can have kids and dogs running around.
So the metrics that investors should be kind of keeping an eye on, right, would be these new customers that you sign up for a subscription only portion of this deal, right?
Yeah. I think the one of the most important ones is like, okay, how many subscribers have you signed on? We already have one.
And what are they? Are they the car owners, or are they, right?
Yeah, that's right. So I think you're going to see a mix, and because in our pipeline for those subscribers, we're seeing a pretty interesting mix. So we've got passenger car operators in there. We've got short lines in there. We've got car owner and car lessor companies, and then we've got some companies, large oil and gas operators, large plastics and chemical operators that have fleets of cars that are all very interested. That's a pretty broad. So when we say car owners, it's a very diverse group of operators, and some of them are very, very large, multi-billion-dollar corporations, and some of them are a bit smaller. So, but all have the same interest in being more efficient.
It just opens up your potential customer base,
yeah,
by a big margin, right?
It does. So we always get hey, what's your total addressable market, from investors, and to be honest, we always kind of define that in a finite way, where we'll cover the network. It's 150 portals, and I think investors that looked at that were like, they're kind of doing the numbers like, well, okay, if you get to 150, you're done. Fill the hotel up, right? In this case, this is now flipped that, where there's a much larger addressable market, and that's just here in North America.
And then just for those people that are doing that math, hopefully you're throwing off enough cash and you've proven this model. I mean, look, this model isn't just for railroads. It just happened to be that's where you focused at this particular point in time.
That's right. There is we have a lot of inquiries and a lot of interest in truck inspection portals. So this is kind of where now the railroads meet, the intermodal and trucking industry. And it's a huge total addressable market, and the demand for the demand for this type of capability is high. As it relates to intermodal operations, at almost every single seaport or a large port of entry, you've got this demand.
Yeah, I mean, and we've talked before. You've also spoke to airlines, right?
We have earlier this year. Yeah, it was the beginning of January of this year. My CTO and I spent a full day with one of the major commercial air carriers here, and with the concept of an aircraft inspection portal. They were very, very interested, and we have done some initial, I would say, research and development on that, but we probably paused that for right this moment while we're rolling out this subscription model here in the rail industry. But that is another area of high interest that we could potentially go after.
Yeah, so look, you look back at how we started this conversation and the cap raise. This is why you did the cap raise, right? This is you're tweaking the model, and I think it's in a very smart way.
Yeah.
So,
well, what we want to do is, some folks were advising us, and there's no wrong answer, but they're like, well, why would you do a smaller raise now and then potentially go out and raise more? And I'm like, I guess for me, maybe I'm just a little too conservative. I'm like, well, what I want to do is I want to prove it first. Taking a smaller amount of money, be thoughtful about how we do that in consideration to our current shareholders and potential new shareholders coming in. Show proof that this model will work, and then with that proof, now then come back and say, okay, we're proving it. Now here's the plan. We're going to go execute it. We'll look for support for that.
Right. And hopefully at some point, Wall Street starts to understand the story and starts to reward you for the efforts that have been made over the last couple of years. Well,
we hope they will. And this is my first time being a public company CEO with a stock.
It's fun, huh?
I'm a bit mystified how it works, but I've been getting some good classes from you, Tim, on kind of the technical aspects of this thing. But I think eventually it's going to come.
No, I mean, look, here's the thing. All I can tell anybody is keep executing, keep doing what you say you're going to do. That's what it comes down to, for me anyway, right? Don't overpromise and underdeliver. That's probably one of the biggies, right? And that happens a lot, but you haven't done that. I mean, you're very, and I could sense your frustration. I think it was it was either the first, it was the second or third quarter. You were the CEO and you had expectations, and I could hear you were aggravated that you didn't hit your targets, right?
Yeah. Well, it's I'm I mean my background, so I'm used to saying when you say you're going to do something, you do it. And if you run into headwinds or friction with it, you figure out how to overcome those things and or find another way. So I think in this case, when I first got here, I don't think there was anything wrong with it, but the idea is we were going to really sell these in large quantities to the Class 1 railroads. I think we found some headwinds with that, and it's going a bit slower than we like. So we've got to adjust our approach and find another way. And I think this subscription model is the way.
Look, and you and I talked, I think the very first time we talked, I asked about, is this a recurring revenue model subscription type software service, right?
Yeah.
I mean, that's my favorite. It's everybody's favorite model. It's just not my favorite model. I mean, it's everybody's favorite model.
Well, it is. And not only from, I think, not just I would say a business perspective where you're trying to make money from that model, but, a lot of large companies, they don't want this stuff on their books, and they don't really, some of these companies, they don't have, nor want to spend the CapEx, to own a bunch of portals and have to support, all this technology. It's just easier for them. And quite frankly, it makes more financial sense for them just to basically buy it as a service and let somebody else who's really an expert at doing it, support it for them and while they benefit from it. But that's the SaaS model.
No, I think this is a much better model. I'm excited about this model because once you sell the portal, you can't keep adding tenants.
Right? That's right. So the other cool thing is, so right now when we put a portal in, we kind of have to get permission from the owner of the portal, which is in this case usually the Class 1 railroads, to basically upgrade it, or add new technology to it. And because they own it, right, they have to bear the cost of all that new technology. But so in this model, what we want to do is, and the business case will support it, where we're going to put these portals in with a certain amount of capability. But then what we're going to do is we're going to upgrade these things on our own. We're incentivized now to do that, and we can do it at our pace, not somebody else's pace. We can go fast. So this is where not only adding kind of some hardware and software upgrades, but more importantly, the idea is that as we add to our artificial intelligence catalog, which we're rolling out now, a year from now, instead of having 28 algorithms that are working, we're going to have 40. And so now the detection reports, as they relate to the FRA and those automated inspections, become even more powerful. And the subscription that you're buying is becoming more valuable and reliable over time, because we're now investing in that, and we're incentivized to invest in that.
And that to me is awesome, right? I mean, my question would be, are those things that, like, I think you're getting ready to come out with 5 or 6 more additional AI algorithms, right? That are going to be coming out.
That's right, and they're going to, some of the new algorithms that'll be coming out. I would tell you, it's not so much now the numbers that are coming out. It's almost like what kind are coming out. So the ones we're going to be rolling out this year, we'll still have some of the standard freight car ones, but we rolled out an oblique view. It's this really cool oblique vehicle undercarriage examiner that really gets up into the nooks and crannies, and the railroaders are really like it. So we haven't really rolled out any AI with that particular piece of kit yet, and that'll be one of the areas that we will work on this year. So we'll add AI to that very, very powerful inspection tool. The second area is for passenger rail. So as of today, we haven't been asked or in a position to roll out any passenger rail AI, and that will be one of our other focuses this year for AI with that. So these are very interesting developments with AI. One of the things that there are lots of AI companies out there, and some of them are working to do railroad AI, but the difference for us is that we control and self-perform all 4 major components of what makes AI, because people want to say, oh, well, AI is in the special little box and it just lives over there. It's like, it's not how it works. You got to have the hardware sensors that, combined with a good IT infrastructure and software, can then now produce and maintain and operate, real high quality artificial intelligence in the rail sector. So we own all 4 of those in this solution. That's why we think our AI is performing so well and is much more compelling than any potential competitors that may come to the table.
That's exciting stuff, man. I mean, I get excited about.
I didn't know anything about software and AI about 2 years ago. I'm just telling you. I do a lot of our hardware stuff. I built power plants. I ran an IT company. I was in the Army. This whole business around software and artificial intelligence, it's pretty cool. The things that these guys can do is it's incredible, and it just for non-technical folks like me, it's really exciting to watch what they do with these images that we get.
And those uses, or those AIs that you develop, they're just going to keep coming, I would think, because as you start to look at passenger trains, it's a different, whole different animal than the freight trains, right?
Yeah, the interesting thing, Ed Harris, my board member, and I were talking just the other day. One of the things that he pointed out was the long haul passenger trains, like the ones from Amtrak, and then they have similar trains up at in Via Rail Canada that are long haul trains. So freight trains often kind of make stops at switch yards to get cut out and kind of reformed, and they're all inspected there. A lot of the long haul Amtrak trains, they basically depart their location of origination, and then they literally travel all the way, on a long haul train
to their final destination.
And there's really no real good mechanism for inspection, a visual inspection along the way. They have sensors on board the trains, of course. There are wayside detectors of different kinds in some of the routes, but nothing like a portal that could do a full-on 360-degree inspection on those passenger trains. So we think that is a very unique and important introduction of safety for those long-haul trains. And we know that our passenger customers are very interested in it. And we think the FRA is also interested and will be supportive of it.
No, it's fantastic. Listen, Chuck, I didn't mean to take up so much of your time, but is there, let's just talk about the chart really quickly.
Yeah.
And that's actually what I've got up here on the screen. It's in a very interesting spot right here. We talked about this before we jumped on the call. This $3 mark is really kind of acting as your big support area, right? Technical guys, if it cracks and closes below $3, they may jump on it. I don't know. Try to drive it lower. How many shares do you have after that's last raise? How many shares do you have fully diluted outstanding?
Faye, I'm gonna let you answer the question because I won't screw it up. Go ahead. Yeah, speak up so you can hear you.
Over a little bit about over the 8 million mark.
Okay, so just over the 8 million mark, right? That is uber super tiny, right? Anything under 100 million in my mind is what I would consider a thin stock. And so 8 million, just over 8 million is pretty thin. It would not take a whole lot to send this thing on an interesting path, right? Now, what's your downside? If you want to short this stock, knock yourself out. What's your risk reward on that? I would suggest that, your risk, your reward is $3. So that's if you go bankrupt, right? What's your risk? Well, I mean, this thing could shoot back up into the, what is that? $12, $13 range fairly quickly. It's been there a few times, right? I don't think it would take a whole heck of a lot to make that happen. And I can tell you that the company would you say the company is significantly different than it was 2 years ago, Chuck?
It is. Leadership's different. How we operationally execute is different and a lot better. And how we're going to market now is definitely different.
How many companies have you turned around?
Well, this will be my third, I'll say, civilian company, and then a number of military units at different sizes.
Okay, so let me ask you a question. From your experience, that you've successfully turned around 2 civilian companies.
Sure, yeah.
Right?
Yeah.
In your experience, where do you feel you are right now? With this company right here today, where do you feel you are in that process?
Yeah, we're in turning around a company. I think it kind of comes in a couple of different parts. The first part is literally just it's the kind of the meat grinder phase where you got to go through, you prioritize, but you're basically going through each of the functional areas of the company and you're making improvements. And a lot of that means improving how you do business, but also a tip for me, it's been improving the staff and how that staff works with each other as a team. And so we are through that phase. We're at the end of that phase. And usually when you come out of that, towards the end of that phase, you've now got the team that you need in place. They're all working together across all the skill sets. You've got yourself financially where you've reduced your financial risk. Still not great, but you've reduced it. And you're also able to what I call control your costs. So you may add costs, but you do it in a very deliberate manner, and it's predictable. In other words, you're controlling it, right? So that's really they got to that first phase. So the next phase now is you basically now take advantage of that base, and then now commercially you begin to grow the company. In previous companies, that's where we started. I would say kind of swinging for the fences a little bit more. When I was in Arma Global, we were chasing a contract with the U.S. Special Operations Command. We were a tiny little company, about $50 million. We're chasing a $300 million contract, government contract, and we're competing against, like L3 Communications. I mean, some big dogs, and we beat them. And all of a sudden, boom, there we go, right? But we didn't really have the capability to compete for that contract until we had that base. So now that we have the base, just like we hear at Duos, now we have the capability to swing for the fences, and that's what I think this subscription model is. And so now we're gonna, that's the next phase. So you get through that, and then the third phase for me is, okay, now you're starting to actually make a lot of money. The value of the company really starts to go up, and now people are fighting over fighting over you. And that's where investors want us to be. That's the third phase.
Right.
And I've had the fortune to kind of be through those three phases at least twice over the last 13 years.
So we're 2 years in. You feel as though you've got your team put together, you've got the right plan, and now it's just a matter of executing.
That is correct. Yeah, executing operationally, but now much more focused now on commercially executing our pipeline,
And
bringing customers, signing those deals, and getting people signed up for these portals. Yeah.
And you expanded the customer base significantly.
Yeah. The addressable
Potential customer base.
Yeah, it's a much larger and quite frankly easier addressable market in that format. Yeah.
Okay, so with all that being said, I believe in you, Chuck. Like I said at the beginning of this, you made me a little nervous because you're always so freaking intense, but but I think you know what you're doing, right? I think you've proven it more than once, and I think now that you feel comfortable with the team that you have, you've got a real clear vision. I think this is when it starts to get exciting. So as an investor, are they ever going to have to raise capital again? Yes, he just laid that out for you, right? However, you can do it from a position of strength. It's a much easier raise, and it makes sense, right? Chuck isn't just going to go just raise capital just to raise capital. There is going to be a very strategic reason behind that, right?
That is correct. That's right.
So I look at it like this. This is you've got a base here at $3. Round numbers are a big deal for people because if it breaks below $3, well, then it's no longer a $3 stock, it's a $2 stock.
Yeah.
Whatever the shorts want to do, they want to play games with it. This is a long-term investment. I want to make everybody very clear. In my view, even though it is a thin stock, this is a long-term play, right? This is a play on Chuck and his team and the vision for what they have and the product that they supply. And I think there is a massive addressable market here, right? I can see insurance companies loving this product, right? Or requiring or giving maybe, people a reduced premium if they use your product, right? I mean, there's all kinds of benefits to this thing I can see. But I don't tell anybody to buy a stock. I just tell the facts. I just share the story. And I think when you have a good story, eventually, if Chuck continues and his team continue to execute, it will reflect in the stock, right? So your downside risk is $3 goes to zero. Your upside potential is really, this thing well, this is not counting for all the splits and everything, but
Yeah.
This does got actually, it was like 24 grand a share.
Yeah, I think, if you take the timeline for the last 2 years, we've hit a high of, it's been the $13 mark. And we had a period of time where we held pretty steady about the $10 to $12 mark, pretty steady. And we had another period of time where we held probably up in the 8 and 9. So, again, I think part of where we're at right now is a product of the market in general, I think. And then I think part of it also due to, people are kind of holding back, they're kind of waiting to see. So, for us, priority is prove that we can hit our yearly revenue numbers, to show that proof point. And then number two, bring this subscription model, which has several components to it, to bear and show that proof. And I think that'll be key for us.
And just to reiterate, because you said this in the beginning of our little episode here, you wish you were a bigger company. You didn't come here to run a little company. That really wasn't your plan. Right?
No. I have had the opportunity to be in 2 different companies that were very small and get them to be very large. And it's a tough ride, but it's a fun ride. And it's a good ride to have when you're working with a great team and the team that you enjoy working with. So that's the goal. The goal is not to be a little tiny micro cap. The goal is to be in that third phase where people are fighting over us, because we're making a lot of money.
Yep. All right, Chuck. As always, man, thank you for giving me the time and telling the story. And when you guys have some new developments, maybe some announcements of contracts that you signed, maybe we can come back and do another follow-up.
We sure will. It's always good to talk to you, Tim.
Same here, Chuck. Hold on one second. Let me shut this off. If anybody's got any questions, though, and there's, sign up. This is what I do recommend. Put this on your watch list and sign up. Go to the website and sign up for investor alerts, right? All you got to do is put in your email address and then verify it. And then you will get every press release that DUOT sends out and every SEC filing, and pay attention to the story. I would, if you don't want to jump in the stock today, fine. But I think you should start at least paying attention to the story, because I do think this is going to be a home run at some point. All right, that's it. Now I can shut it off. Hey there, all you stock market junkies. Thanks for tuning in to yet another CEO follow-up interview. Today we had Chuck Ferry from DUOT Technologies, ticker symbol DUOT. I hope you enjoyed today's interview, and if you did, do us a favor, give us a like. How about giving us a share? And while you're at it, why not give us a follow? Until next time, stay safe. Alpha Wolf Trading wishes you the very best of success.